then it's known as inventory. So if you buy shoes today or order things from China, for example, with the main purpose of reselling those items, then that is your inventory. And an inventory is also classified as a current asset. So why do you think inventory is classified as current asset? Inventory is a current asset simply because this belong inventory is something that belongs to you. Remember, all assets are items that belongs to you, right? They are your properties. But in this case, it's a current asset because it can be converted into cash within a short time of period. Ne? Meaning that you can have a lot of items today. You can have a huge amount of stock today. But if you do business very well, then tomorrow everything will be done. If you manage to sell everything that you had today. So what did you do? You converted it into cash, ne? Easily. So it just takes a day or 2 days or a month to convert your inventory into cash. And that's why it's a current asset. Okay, it says that not all businesses hold inventory. Now what does this mean? We said you have a lot of different kind of inventories. Businesses, ne? But not all businesses hold inventory. For example, service rendering businesses such as a salon, a barber shop, those kind of a school, those kind of businesses. What do? They render service, so they do not have inventory. So inventory only has to do with trading accounts. I Sorry, not trading accounts, but trading businesses that that do trading, ne? That sell items and they do not render service. What they do is they sell items. So those are the kind of businesses that hold inventory. Okay. And then what is happening? So we move on to valuing inventory. Value of inventory. It says that inventory is recorded and valued based on lower of cost and net realizable value. Therefore, we mostly value inventory using cost price. Now, what does this mean? This simply means that when you value your inventory, make sure that you value it at the lower of cost, meaning that you have the cost price and then you also have the selling price. Now, when you are going to value your inventory, you do not value it according to the selling price, ne? Because you are not sure of whether you are really gonna sell the whole stock that you have, ne? That's why it is recorded at value of lower cost, meaning that you need to record it at the cost price because that is the lowest cost of your inventory. That is the lowest price of your inventory. So you cannot value your inventory saying that, okay, no, I have 5 pairs of shoes. Now these 5 pairs of shoes, each shoe cost me a $50, ne? And I'm now selling every shoe for $100. So obviously that the total sales will be $5,000. So you cannot value your inventory saying that, okay, my total inventory that I have is worth 5,000. Simply, 500, simply because you are selling every pair for $100. No. So what you need to do is you need to value it at its cost. Meaning that if you have to value your inventory of the 5 pairs that you bought at $50, then you have to value your inventory at 250. That is the cost. You cannot value it at the selling amount because you are not sure of whether you are not certain whether you will really sell all the shoes. You understand? So meaning that when you're going to draw up your income statement or your income statement and you valued your inventory at the selling price, so what will happen to your net profit? Obviously, it will be overstated. It will be more than it was really supposed to be. Do you understand? Can you guys hear me?
Yes.
Okay. And then we will not, okay, it says that we will not attempt to value inventory based on sales value. You see? So we will not, we will therefore we will not attempt to value inventory based on sales value. Why? Because we might not manage to sell off inventory, and inventory also does not meet the criteria of being recognized as revenue yet. So we cannot value our inventory based on sales because we are not sure. What if we do not sell off the whole inventory? Then what? And you cannot recognize, inventory is not recognized as sale, as revenue, ne? As income. You cannot recognize inventory as revenue until you really make the sales, until you sell those shoes. That's when you can recognize your inventory as revenue. But for as long as you did not get a customer of those shoes, then you cannot say that, okay, no, I have $100, I've made sales, I have sales of $100. No, you can only recognize it when you get a customer who promises to pay. And then we move on. Measurement of inventory. So there are two systems of keeping stock. Ne? We have two different kind of systems of keeping stock, the perpetual and the periodic system. So these systems are very important. You can be asked to explain or to give the difference between the perpetual and the periodic systems. So let's start off with perpetual. So what is the meaning of perpetual? So when the perpetual inventory system is used, inventory purchase is recorded in the inventory account. This simply means that when you are using perpetual system, whenever you buy goods, whenever you buy your inventory, then you will need to record it into your inventory account. You will need to record it in your ledger accounts, meaning you keep records of all the inventory that comes into the business. That's the meaning of perpetual system. Whenever you buy, you record. Whenever you buy, you always record. There's no way you'll buy inventory without recording it using the perpetual system. Now, all costs incurred in bringing the inventory to its current location and condition are also recorded in the inventory account. Meaning that, remember that the cost of buying a set of buying something includes all costs, ne, involved in buying that certain good. What does this mean? This simply means that if you had to go buy shoes today, ne, so the pair of shoe is maybe of the pair of shoe is $50, ne, and you are taking a cab to town. Taking a cab is $12 going and coming. So when you are going to record your cost, you are not going to say that, okay, my pair of shoe was just $50. No, you have to include all the costs that you incur to bring the inventory, to bring that good at your house or at your store. That is the total cost. Whether this has to do with everything, whether they are fixed assets, whether now it's your inventory, you need to include all the costs that you incur just to bring that item to your place. So if you buy shoes today worth $50 and then you incurred you had to pay transport dollar of maybe $32, then your total cost of those shoes will be how much? It will be 82. 50 plus 32 will give you 82. That will be your total cost of the shoes. Okay, and then we move on. Please, if you have any questions, feel free to ask. So
Okay.
um and then we move on. So it says that all costs incurred in bringing the inventory to its current location and condition are also recorded in the inventory account. So you do not just record the cost price. You need to include all the costs involved, because those costs make up the whole total cost of that certain item that you bought. Okay. And again, it says that each time a sale is made, the inventory account is updated by deducting the cost price of all inventory items sold. Now, what does this mean? It says that now whenever you buy your inventory, you need to record it. You need to include it in your inventory account. Now, what happens when you sell those shoes? Now, when you sell your inventory, you mean you what you need is you need to deduct the cost price of those items that you sold. Let me say you had five in your inventory account, you recorded 5 pairs of shoes, ne? And they all cost $50. The total cost of them each is $50. So what is the total cost? Is 250, right? Now, what happens if you decide to sell 2 pairs of shoes? Meaning that you need to deduct their cost price. And 2 pairs of shoes, their cost price is how much? It's $100. So in the inventory account, you need to deduct 2 pairs of shoes, or you need to deduct $100. So you update you update your inventory account. Whenever you make a sale, make sure that you deduct the cost price of all the items that you sold. I hope it's clear. And then it also says that each time an inventory purchase is made, the inventory account is updated by adding the cost price of all inventory items purchased. Meaning now, each time whenever you purchase the inventory, you have to update your inventory account by adding all the cost prices of the inventory that you purchased. Now, after you sold again, you did okay. So you after now selling the 2 pairs, you decided to buy more stock. So after now, when you buy more stock, you still need to update your inventory account. You need to add the cost price of the inventory or all of the items that you just purchased. Now, this whole thing has to do with perpetual inventory system. Now we move on to the periodic inventory system. Periodic inventory system simply means that now when periodic inventory system is used, the cost of inventory sold is calculated at the end of the financial period. Meaning that if you are using periodic inventory system, you do not keep records of your inventory coming in. You do not record your inventory when you are receiving your inventory when you sell the inventory. You do not keep records. What you do is you only calculate it at the end of the financial period by doing what? By doing a stock taking. So this is done by adding purchases and all costs incurred in bringing the inventory to its current location and condition to the opening inventory. And it says that the closing value of inventory, which is determined after a physical inventory count, is then subtracted to calculate the cost of sales. Meaning that now, how do you calculate now your inventory? First, you first you calculate, okay, at the beginning of the financial period, I know that I had 50 shoes, ne? I know I had 50 pairs of shoes in stock. Okay, and then you take in the during the year, you take all your receipts. I mean, all your receipts. Ne? When you went to purchase all the receipts, you take all the receipts, and then you calculate the amount, the number of items that you bought, the number of shoes that you bought during the whole year, and then you will have to add them to your opening inventory. So that was the total inventory that you had that year. Now, finding your closing inventory, obviously, because you do not keep records, so you do not know the value of your closing stock. What you need to do, what you do is you need to go to your market and do stock taking or and calculate the number of shoes that you have. You see the difference between periodic and perpetual? If you are using perpetual, because you keep recordings, at the end of the year you won't have to go count physically, to go count your items physically, because you already have all the records. But with periodic inventory system, you do not keep records of your inventory. You do not calculate, you do not record your inventory, so you will be forced to go to your market or wherever you are operating it to go physically count the number of items that you have left. And that's when you can get the closing value. Okay. And then we move on. If there are no questions, please, if there are questions, feel free to ask. Okay. If there are no questions, we move on to the valuation methods, the most important part of this, the most important part of this whole topic. So there are three types of valuation methods. There are three types, or there are three methods on valuing your inventory. First, you have first in, first out, last in, first out, and weighted average cost. So what is meant by first in, first out? First in, first out simply means that what came in first, you sell out first. So the total items, the items that you bought first, or the items that came in first, should be sold out first. For example, yesterday you bought stock, right? And today you decided to go buy stock again. Now when you are selling, you first sell the stock that came in yesterday, because that's the stock that came in first. Now, after you are done selling the stock that came in first, that's when you can sell the stock that came in today. That's the meaning of first in, first out. Meaning that it assumes that first lot of goods received are first goods to be sold. So the goods that were received first are the ones that should be first sold out. So it also assumes that the cost of goods in inventory will be of that of first or lot of goods received. So the cost of goods that you will use, né, is the one of the goods that came in first. Now that is first in, first out. And then we move on. Okay, we have an example of FIFO here. So I'm just gonna explain all the methods, and then we can do the calculations together of both the three methods. So we have last in, first out. So last in, first out simply means that what came in last should be sold out first. So what came in last should be sold out first. So if you bought inventory yesterday and then you bought another inventory today, so what you sell out first is the inventory that came in today. That's what came in last. And then from there, that's when you can sell out the inventory that came in yesterday. So you first sell out the items that you received last. So it assumes that last lot of goods received is first goods to be sold. So the goods that were received last should be sold out first. And the cost of goods in inventory that will be used is the one of the last goods received. That in last in, first out. Okay. And then the last one is the average cost. So with the average cost is totally different from the other ones. When it comes to the average cost, it does not matter which which inventory came in first and which came out first. I mean, so it does not matter which inventory came in first and which one came in last. So you sell out whatever, né? Whatever item you sell out, regardless of whether it came in first or it came in last, you just sell. Now, how do you do this? You issue them out. Remember that we said that we issue out our inventory using the cost prices, right? Now with the average cost, because we have different kind of cost prices and we are not focusing on which one came in first and which one came out last, what we do is we need to calculate the average cost. We have to issue out the items using the average cost, using their average cost. And to calculate average cost, it's total cost divided by total number of items. We'll get to this when you are going to do the example together. Now it says that average cost of sales are recalculated with each receipt of goods. Now we say that we value our inventory using the average cost. Ne? Using the average cost. Now in this case, instead of you using the cost prices, you use the average cost. Now each and every time you buy, so each and every time you buy stock, you need to recalculate the average cost. You need to calculate a new average cost whenever you purchase inventory. Then you will need to calculate a new average cost that you will be using. It says that the cost of inventory is calculated on average cost of goods received. Ne? Now, regardless of whether this one came in first or which one came out last, you just sell whatever, because all of the products, all of the items will be using only one cost, which is their average cost. So that is the average, the weighted average method. So we came to the end of our explanation. So we are going to do activities, but before we do the activities, I would like to find out if you have any questions. Any questions?
No. No question.
Okay. So if we have no questions, so if we have no questions, okay, I don't know how we're gonna do this, but I would want you guys to please, if you can capture this activity, because I won't be sharing the slides anymore. Since you are going to do the activity together, what I'll share is the whiteboard. So I have to stop sharing the slides. So please, if you have just quickly capture this screenshot. I think screenshot will do. Or should I send it to your WhatsApp?
Maybe we send it. Yes.
Can you guys screenshot, or can I quickly send it? Or do you guys already have the slides?
I already have a picture.
Huh?
Uh,
So I was saying, can you guys screenshot, or must I quickly send you the slides? Because I want us to do the activity, but I won't have the.
Please send the slides. Tina.
Okay, let me quickly just
You
share
can
the
send the
slides.
slides.
Okay, I'll do it right away.
Okay.
Yeah. Okay, done sending.
Okay.